should be able to already see the screen that Jordi is sharing. But let's give it a couple of minutes until we start to let more people join. Okay, one more minute. Let's wait another minute and then we get started. I'll also share, although I'll talk about it more at the end of the talk, the link to our the Startup Academy site that you guys can have more stuff regarding our courses. I will describe them more at the end of the video, but we also have tons of content there if you guys are interested in more stuff. So let's get, and we start at 5:33. All right, 5:33. So I guess we should start. Okay, so first of all, thank you very much for joining for this session. I will introduce myself and Jordi, who is our guest today, that will tell us more about the VC ecosystem in 2023 and 2024. It's actually a pretty interesting topic. I think that every year is a typical reflection moment, right? Like January to say like how last year was and how next year is gonna be. And on the Startup CFO, we often work with the startups ourselves, but it's great to have both points of view. So last week we gave a webinar on Thursday with 𝗵𝗶𝗯𝗂𝗫𝗍𝗶, our CFO director, more from the point of view of the startup, of okay, what's happening and how should I prepare if I'm the startup? But today we're gonna have the point of view from the venture capital. So to see what happened and what will happen, what are the key trends, what's the economic landscape, market, and all that stuff. So if one slide ahead, you guys already know us, that we are the Startup CFO. In the Startup CFO, our main service is being fractional CFO for startups. So startups that still don't need a full-time CFO or need help with funding rounds, with controlling, with modeling, with forecasts, investor relations, how to prepare for a funding round, all that stuff, we take care of that. And we have already served over 200 early stage startups in over 20 countries. We are a team of 27, if I'm not wrong already. And we have offices in Madrid and Berlin. So if you guys have any need on that end, contact us. There's also another initiative that we launched already 2.5 years ago, which is our Academy program. Our Academy program is, we will talk about it later, it's 2 courses that are completely online that cover, one of them, everything that there is to know on startup finance, and the other one, everything that there is to know on venture capital. And the fact is also that in the venture capital course, Jordi, that I will introduce now, helped us building all the materials for the course. And then also, as I was saying before, in our YouTube channel, I shared the link, I can share it again now. In our YouTube channel, you can also see tons of content that we have created in other webinars similar to this. And coming from these initiatives, we wanted to give this webinar. on navigating the VC landscape, learnings from 2023, and preparing for 2024. And with us today, the guest is Jordi Vidal. Jordi is principal at Kibo Ventures. Kibo is arguably the best VC fund in Spain. If not the best, definitely would be top 3. They have invested in several unicorns already. They have an incredible track record, incredible portfolio. They usually co-invest with the best funds in Europe in bigger rounds. So definitely people to listen if you guys are interested in the venture capital world. And Jordi, on top of that, great friend and great friend of us at the startup CFO. So, well, he knows more than me, as you guys will see. And I would like to start asking, like, okay, so what are the key trends, challenges, and opportunities in 2023? Jordi, I'll let you introduce you and go ahead with that.
Hi, everyone. Just adding to Jaime's words, thank you all for being here and for listening to us. We hope you find the content and the things that we are going to be talking about today useful. Just a super brief intro on myself and Kibo Ventures. We have been investing in venture capital and in technology companies since 2012, more or less. We have done over 70 investments, over 300 different operations, venture capital operations, from, doing initial tickets in companies to follow on in other companies, etc., etc. We've been lucky to be able to do some relevant exits in the ecosystem, like selling a company to Apple or company to New Relic, and one of the things that we've also been super lucky to be involved with is the IPO of one of our investments, which is Flyware. And from my side, I've been working within the firm since 2017, so almost 7 years, and also have been very lucky to be involved in a bunch of different deals and in different things. So going into the topic that we have for today and what we've done with Jaime's, we've prepared a few slides so that those slides can guide us through, everything that we will be talking about. But the main idea here is if you want to make any questions or contribute with anything, that would be super, super appreciated. So Jaime, you want to start with any specific question, or you want me to jump in on any thoughts about key trends and challenges?
Well, I wanted to emphasize first, the more dialogue we make it, the better. Please feel free to use the chat or the raise hand function, or even like unmute yourself and ask if you guys want. We are not too many that wouldn't work. So
we are seeing a bunch of familiar faces, so maybe we'll drop some questions also to you guys.
Perfect. Great. So yeah, in general, okay, first question, like, how do you see 2023? Like, to me, it seems like the first full year of the, let's call it VC winter or VC downturn that has been called, that started more or less, I would say, May 2022. So it would have been the first year. But at the same time, with that like cold atmosphere, at the same time, like anything that had the 2 letters AI since the end of 2022 was absolutely crazy. So what's your take on that?
Yeah, so that's why we throw up this chart here. One of the trends that we have definitely seen in the market globally is AI. We've seen massive funding rounds, like obviously OpenAI, but others that might not be so well known, like Anthropic or Inflection, and other smaller ones like the ones we're showing here. Mistral AI, a French company that's building its own large language models, and also 11 Labs, which is a voice AI company that was born early 2023 and is already a unicorn by having been backed by huge funds like Anderson Horowitz. And from the VC point of view, what we have seen is that this is obviously a super nascent technology, but something that's already producing relevant levels of business and relevant levels of also funding. And what we are seeing is that after the peak in 2020, 2021, and the first part of 2022, the only thing that has been, getting huge amounts of funding in terms also of valuation, deal sizes, AI would be the exception to the norm of what we've seen in other sectors like software, where the deal volumes have been a little bit slower. And there's also like 2023 has been a year where good founders have been able to raise money, because there has been a lot of funds that raised their funds during 2021 and 2022, which basically means that there's tons of dry powder. So good companies still raise funds, but there's a very high bar, I would say, to raise from venture capital funds. And the only exception to this has been probably anything related to AI. One of the important things to bear in mind here is that these kind of companies, they require tons of money because the computational requirements that they have. So you need to pay tons of infrastructure, and a sample of that is if you see what has NVIDIA, which is one of the main providers of infrastructure to any AI company. If you see the evolution of NVIDIA in the stock market, you can see that they've had their best year in 2023 in terms not only of growth but also of stock performance. No? So,
but a couple of questions on that. So I'd say then that some people profited from being the guy that sells shovels in the gold rush, right? Rather than looking for gold, habilitates the gold diggers. But here, I was a little surprised by the cost of infrastructure. So what does it say about the gross margin of these AI companies? Like in the end, I guess that you cannot offer very cheap AI services if you have tons of expenses for them, to train this model.
Yeah, so I think there's two things here. So one is when you're running your own LLM, which is everything that we're seeing with OpenAI, Anthropic, Mistral, and the other one is trying to build a business on top of that. I think this second part, which is basically using all of these technologies and leveraging them to build a business on top of them, I think we're gonna see this during 2024. Whilst the more infrastructure part, or being able to enable anyone to use this technology, we've seen already a bunch of money and a lot of money thrown there, and a lot of players which are already becoming a gold standard, both on the private companies like OpenAI, but also companies that are more open source like Anthropic or even Mistral that's opening their models. Truth is that these companies, there's an important thing here, which is pricing for these companies is it's not super clear. Like what you have is OpenAI doing 1.2 billion in revenues this year with premium subscriptions. But, those others that are more B2B or, opening their technology so that others can build on top of that, the pricing is now a structure that's, done through tokens, but it's not clear. But what is really clear is that these companies that are offering their LLMs, they are building their own and thinking on their own business model in a way that they are, highly profitable and with high margins. I think the key question here is anyone using those companies. So if you want to build something on top of OpenAI or on top of Anthropic or on top of, Midjourney or whatever, that's where the margins I believe are not gonna be so big. But I think it's something that we will see over time, and during 2024 it's gonna be one of the key things that we as VCs will be trying to understand and trying to think how we wanna this to play out.
I see. And what about the smaller startup? Because we're seeing here huge mega rounds in huge companies. What about smaller startups? Also following the AI trend?
Yeah, but I mean, Mistral, when they raised this huge round, they were a 4-people team. Like it was a small startup, even though
they raised 400 million.
Even though they raised tons of money. not 400. I think it was the first one they raised. I think it was 100. It's not this one, but even though it was a huge round for a company, you know, that size, I think that those are more smaller companies. We're gonna see what happens there, because I think it's not clear how those companies are gonna be able to build offensibility. Because all of those companies, I think it's gonna be more about distribution and finding some super interesting use case where you can leverage this technology, but not, you know, building defensibility from the product side. So we'll see about that.
We'll see. What about, by the way, like actually, also in AI, people are talking about the cost and the environmental potential harm, like the contamination this can produce. That another keyword this year was the sustainability and clean tech and everything related to that.
Yeah. So what we're seeing, like climate is also a space where 2023 has been, or I would say it's a space that has been very much a space of interest for climate investors. And there's been a lot of money raised by investors, you know, with the focus of, you know, trying to solve somehow this big issue that we have with climate today. And I think that here there's also a key thing, which is we need to really understand if there's so much money to be made in climate. I believe, yes, I believe the problem that we have is huge as a you know, as a society. But I believe also that, you know, there's not that many real business models or, you know, real use cases where technology can tackle that. And we've seen, for example, a bunch of carbon credit marketplaces in the market are raising tons of money. But the truth is that the supply for those marketplaces is not there ready. Like companies are not really, or even they don't know how to, you know, how to sell carbon credit. So we'll see about that. I believe this trend is going to be, and we'll talk about this later, but I think it's going to be something that's going to still be the norm in 2024. We're going to see tons of climate companies raising money. And I believe that mostly the ones that are able to show that there's a business model that can be built out of this and money that can be made on some sort of, you know, profitable way in the long run.
Yeah. Also, it seems from the chart that with the exception actually of Q3 2023, but like there were more deals, like more and more deals with like similar deal value. So I guess there are like many early stage startups coming in the field, and let's see.
Yeah, it's a very nascent thing. Like if you take what was happening 4 or 5 years ago, and you can see the numbers here on the bars, it was still early days for these kind of companies. Now I believe, and I think this has a lot to do with regulators, like regulators from, you know, both US and Europe and I guess the rest of the world, but regulators are really pushing for, you know, not only companies to be, you know, to do good and to don't be super harsh with emissions, etc., but also to money, like to money that flows into companies, to investors, to really look for companies that are really in this space or that can be good at the end for the environment.
I see. Perfect.
And we had, I think we had a third one, but I don't know if you want to dig deeper on climate, Jaime.
Well, what else? Like we covered AI, climate tech.
Yeah,
what else there was in 2023?
This one was more some heart of some sort of a thought, because 2023 has been a year where Web3 has been completely forgotten. But what I believe is that you need to bear in mind that during 2021 and 2022, there was a lot of money that was raised by Web3 companies. And I believe that this year in 2024, there's going to be some of those companies that have been, you know, very quiet, building things, building product, you know, thinking about relevant use cases where decentralization can really matter, that are going to come out to market and are going to show us good businesses and probably going to attract more money in 2024. So probably, I don't know, we'll see about that, but we might see some companies in the Web3 space raising money in 2024, and and building good businesses.
So you mean not as good as it seemed on 21 and 22, but not as bad as it would seem in 23.
Yeah, completely agree. I think that what happened in 2021 with Web3 is that it was some sort of, it was a bit crazy. Like things that were being funded were, well, it made not a lot of sense from a business point of view, and even from a demand point of view. It was there was a lot of FOMO, and I think that now, and also obviously there's Bitcoin and Ethereum that have performed super good this year. I think Bitcoin did a plus 68% in 2023, and Ethereum was someone around 30% in performance. So I mean, I think that this tied with the fact that there's a bunch of companies that got very good, well funded in 2021 and 2022 that have been quiet building products and understanding customers. This might provide a good year for Web3 in 2024.
I see. Yeah, there is like, I mean, kind of a mean question, but like, how much like VCs follow rational thought, or how much you guys are dragged by the industry as a whole? Like, if everyone is invested on this, I cannot miss it, versus like you guys like truly follow. It's a mean question, and
it's super fair. It's super fair, and it's super fair. And I mean, there's a bunch of funds that have lost tons of money investing in Web3.
By the way, it's very easy to ask this from my side of non-investing.
No. But the truth from an investor point of view is that you need to have your thesis and really understand what are the trends that you want to jump in and you want to be betting on, and understand the ones that you believe are not gonna bring value, and that's part of the business.
I see. Perfect. Now it makes sense. I guess like you only see the true potential in time, and that's why it's venture capital and not just investing in the stock market.
And last thing, which I think it's important, and it's part of the answer to the question on what the challenges have been. And I think VCs, we always go back to the same, but it's a reality, which is I think regulation, it's gonna have a huge impact on the AI thing we were speaking before. I think it can be a part of a slowdown for AI in 2024. But if regulators are really hand in hand with both companies and investors building here, they can also be a huge support for the whole industry. I was reading a post by Brad Phil the other day, and he was saying something like, how are regulators going to react to the fact that all of these LLMs are using information that's public in the internet, but at some point the information is owned by someone, probably whoever wrote it or whoever posts anything on internet, and OpenAI is using that to be smarter or to answer some questions. So I think that's a huge thing that we're gonna see during 2024.
Yeah, I think again, not being the expert on the technological side, but obviously regulation, and I think in your document you had a slide on it that it's also like one of the things. Exactly. So I mean, also I heard the analogy that made sense, that it was like, okay, at the beginning of the internet, you could talk a lot about internet scams, fraud online with e-commerce or whatever, or identity theft, or like people would think like, okay, my kids are chatting with someone online and they don't know like who that person is. And that of course didn't invalidate internet, it's like, okay, we overcame that, or we learned how to live with it, but that doesn't mean like the technology is wrong. So I'm afraid, and if I'm not wrong, like a couple of weeks ago, some new regulation was passed in the European Union, right? That I don't know the impact. I don't know if you can give us a little hint on that, but it seemed to me a little too heavy against it. It's like, okay, hold on, this may have some downsides, but like let's not kill the thing.
Yeah, it's an interesting thing. What, for example, you said about Apple or to Apple, it has a huge impact. I don't know if you were talking about this one specifically, but this is an interesting thing, because the Apple Store was born maybe 10 years ago, or even more, 12 years ago, like when the first iPhone came out. So long time ago, even a little bit more. And now EU is regulating that. So again, we see another example on regulators, coming a little bit late towards technology. And I think, technology has been always ahead of regulators. But I think that with AI, the risks it has, and also the way AI uses information and data, and the regulators are gonna have to, get themselves up to speed.
Makes sense. Let's see what happens. Let's keep the good part and not the bad part. Okay, moving on to more like we saw like these trends and like the main industries and all that stuff in 2023. So industry as a whole and the impact on valuations, which I guess it must be heavy in an atmosphere like this.
Yeah, I mean, it's always the same with that, no? Like regulators are gonna be. I mean, they need to do their job, and companies need to adapt to that. So we'll see.
Okay, so we see here that like minus 42% in venture capital investment in 2023. So you were saying that there's dry powder because, and I think this is a super important insight. I actually was commenting it today with the academic community. So many funds were started in 2020, 2021, maybe not so many in 2022, that they still have money in the bank. So what would explain this like trend of like investing less if they do have dry powder and funds to invest in 2023?
So I think there's a bunch of things that have happened this year that are very important. The first one is we need to remember that we come from 2 years where it became crazy. The amount of money that companies were able to raise, the valuations that funds, were setting to those companies, and also COVID. I mean, those 2 years basically are, the effect of a policy that was, we are having this worldwide situation where obviously this digitalization plays a huge part, in order to recover from that. And then there's a bunch of things like, a zero interest policy rate in order to overcome this crisis, and a bunch of things that made a couple of things, very relevant. One is the digitalization part, which seemed to be super important during COVID. And the second one is that money was almost free, both for investors to raise, but also for entrepreneurs to raise, given, this zero interest rate policy. And what we're seeing in 2023 is a bunch of things like this policy is completely ended. Silicon Valley Bank collapsed. There's a global economy slowdown. So what this has made is, okay, GPs are saying, okay, let's, reevaluate the way we have been doing things over the last 2 years, reevaluate, what kind of companies we want to be investing. There's not going to be that much appetite on, tech companies in 2023, 2024, and going forward. So what we need is to really bring in companies that are super solid, not in terms of growth only, but also in terms of, their bottom line, profitability, etc. So I think the combination of this is why you've seen, this drop on VC money and VC deals being closed.
But in the end, like imagine a 100 million fund that is gonna last 4 years, and they started in 2021. Like the money that they are not investing in 2023, will they invest in 2024, for example, or they make the capital calls, or they?
Yeah. So basically, what we saw in 2021 and 2022 is that in 2020, sorry, and 2021 above all, is that funds were having deploy payments or pace of deployment that were super fast. Like probably 100 million fund being invested in, I don't know, 10 to 12 months, while, the norm during the previous years, was deploying a fund between 3 and 5 years, time of deployment. And I think that this is, we're going back to normality, and normality means a fund that you raised in 2021 should be, should be completely deployed in 2024 or 2025, and not in that not that fast as it was in 2020 and 2021. I think that's part of, the reason why there's been some sort of a slowdown. Like GPs are really, taking care when they choose companies, and they have realized that, money is not free anymore. You need to really go back and try to fundraise for your next fund when you can show that you have been or you've done a very good job with a previous fund. And that basically means, taking your time to pick the investments, picking investments that, can really survive without money and without this environment where money was almost free, etc., etc.
What about the survival of the? Well, I guess we have another slide about this later. I will just mention, and then we can cover it in more detail. I was thinking that the survival of the funds themselves. It's like there are X number of firms in the world, and if there's less money in VC, less than X firms. So we will cover that later, and I think it's
we can jump later. Yeah, the next thing we had here is how this is basically related to multiples, and this is a very interesting trend. And if some of you guys is fundraising for your companies, this is an important thing to bear in mind, and it's very much tied to the way things were done in 2020, that basically put prices, and multiples were above the sky. And now if you can see here in the chart, we are somehow back to normality, or back to where we were in 2028, and so in 2018, 2019, something like that. Basically here, this is public companies multiples, so revenue multiples, valuation to next 12 months revenue. And what we are seeing here is basically that we are back to normality, and that's very much related to the fact that there's not that much amount of money being invested, and that things are being done a little bit more carefully.
Great. Well, in my opinion, this chart we could go on for hours, and I will give you some analysis that I have. But by the way, I remind everyone that it's just like the middle of the webinar, that if you guys want to ask any question, please on the chat, and we'll bring it up, or unmute yourself, raise hand, whatever you guys want. Jordi and I could be talking about this for years probably, but if you guys jump in, that'll be great too. Anyway, in this slide, to me, there are many interesting things. One of them is that before 2019, and even it crossed one line crossed the other. So before 2019, especially 2017, the valuations over the revenues are more or less follow the same multiple for companies with high growth, mid growth, or even low growth.
Yeah.
Which then would make me think that the valuation was mostly based on something else. If there's no correlation to here, it's it wasn't even one of the most important factors. It is true that if talking about startups, especially I would say in Europe, 8 years, it's a lifetime. And 8 years ago, it's prehistory. But I find that crazy. I don't know if you have another explanation, but it seems to me.
No, I think I was gonna go to the last thing that you said, which is this chart starts way a long time ago. And in 2015, if you take, Europe as an example, and you try to figure out how many public tech companies were in Europe in 2015, and there's, I would say, a handful. And now if you do the same analysis, what you're gonna find is that there's way more tech public companies than before. And if you see what has happened over the last 10 years and what are the companies that are really driving the economies, you take, for example, the 5 biggest companies by market cap in 2023, and or the 10 biggest companies by market cap, and I think 8 of them are tech companies that have been funded by VC over their lifetimes, which basically means that there's a huge value that's being created in tech companies, and all of those companies, or almost all of them, have been on a growth path that has required VC money. And that's why I think the key thing here is that tech companies have become way more interesting for investors than they were 10 years ago or so.
I see. But still, then in late 2020, like in my opinion, I always thought, especially at the beginning when I started working with startups, that it's pretty crazy to value a company out of the revenue. You know, like, okay.
Yeah, the problem is that how would you objectively value a company that's losing money?
That's true. No,
Which is the
that
case
I
of
understand.
most of them.
No, then the answer, and I think you and I have talked about this in the past, then I guess the answer is that it's a proxy to what can be, like, if the company is truly scalable, you could claim that in infinity, or in the exaggeration, or in the infinity, in the ideal, the company would have like very, very low cost compared to its revenue. You know, I have like profitable units of like any type. It can be customers, it can be geographies, it can be anything. I have units that maybe have, let's say, 90% gross margin, like many SaaS business have. And it's like, if it's truly scalable, I could have as many as I wanted. So the margin would be huge. So the revenue is not that far from the margin that I would have. If, correct me if I'm wrong, more or less. And this is like a way to make a proxy for a DCF calculation. But then, to me, like 40 times revenue sounds something like, if you wanted like to project that growth, you know, and then like the cash and that being healthy and that being in so fast that it can give it back, like 40 times sounds pretty crazy. But I guess smarter people than me paid it for a reason.
Yeah, I think when you take these companies which are already public, already super big, they can, you know, they can grow, but they can't grow, you know, 2 or 3 times year over year. It's impossible just because of the size they have. That can be true, but it's also true that when you take huge tech companies and you see their profitability profile when they become profitable, it's huge. Like, they are being able to replicate what those companies did with revenues back in the day, and they are replicating that with the profits of the company. So profits that are also growing exponentially. And there's, I think it was Nubank, which is a Brazilian Nubank, and there's a super interesting post about Nubank on that, where you can see that the company has been non-profitable for a long time, but then when they started with they reached break-even and they're starting to become profitable, profits really grew like exponentially. And I think that's where, you know, where you can really try to assess that, you know, long-term profitability and long-term, or you could try to do a DCF. The problem is that we VCs, we are way far from that. Like, we're talking, you know, about, you know, 6, 7, 8 years down the road.
I see. And also, something I was thinking about this chart is that it doesn't tell us how many deals each of the lines have in different time. Yeah. So I would ask you personally, for Kibo or for you, and in general for the industry, what would you rather have now? A high growth company valued at 16x, a low growth company valued at 4x, or a middle one for 8.6x? It's also like obviously very general question, but
yeah,
thoughts on that?
Yeah, so the way we do things is we really push for growth, even though we are, and there's a good slide after this one that shows, you know, the before and after the 2021 bubble in terms of, you know, what really mattered to VC funds. But answering your question, I would say we are really willing to pay for growth. But what we are really trying to understand is that the company on the long run, like maybe 4 or 5 years after we invested in them, they will have the levers to, you know, become profitable if they want, or, you know, still be losing money, but, you know, growing heavily. And I think we are willing to pay a premium because of that. No, at the end, we invest in companies that, you know, and one of the facts why we only invest in tech companies is because those are companies that, you know, have the business models and the profile as a company that really can allow them to grow heavily. And I think that's one of the key things. If you were to ask me, I would say, you know, good growth, but showing paths to profitability, or, you know, showing very strong unit economics. And we are, you know, maybe willing to pay, I don't know, 9 or 10 times annual recurring revenues on a company that's growing 2-3 times over a year and with very relevant unit economics.
10 times revenue of a company that grows 2-3 times.
Yeah, 10 times recurrent revenue.
Okay, I see. I mean,
so
to me, that means high growth.
I think it's important to note that for SBCs, I think there's two things that really drive multiples, or the multiples that we choose. And we normally operate and we always talk about revenue multiples, and that's because companies that we invest in are not profitable. So there's not other, P&L line that you could really use to, put a multiple on. But I think that the two things that really drive that multiple, either, if it's higher or lower, or, in which range that multiple is going to sit, is first of all margins, and second, the quality of the revenues. And that's why, I said recurring revenues, and I was meaning recurrent revenues with, tech or software margins. So the other thing that really matters here is the margins that you are really having, no? And it comes, back to what you mentioned before, Jaime, about, the profile costs of these kind of companies, and the expected growth. And here I choose this analysis. I think it's from Bessemer, and it's an interesting one, which basically shows how important was growth back in 2021. And November 21 was when there was a huge peak in technology investment, and how these has evolved until now. So in 2021 growth was 6 times as important as profitability, while now we are talking about 2 to 1, so way more efficient companies is what we are looking for, no? And also what we are seeing in public tech companies is that their profiles have pivoted towards a more sustained growth. So an interesting number that I was watching the other day is in November 2021, if you use what's called the rule of 40, which is a rule that a lot of investors in technology use, which basically adds up growth and profitability. So it adds up the growth that you've had for the year, and also the free cash flow or the EBITDA that the company is generating for the year. There's a lot of discussions between if it has to be free cash flow or EBITDA, but basically it's how profitable you are. And in 2021 November, if you took the 40% rule, it was sitting at 45% for the 5 most valued tech companies in NASDAQ, I believe. And this 45% was composed by 60-ish growth and minus 15% profitability. So companies were, growing at all costs, even by being non-profitable. And if you take this number now, the number is over 45. I think it's like 50-ish, but it's, a mix between a 30% growth and then a, 15-20% profitability.
I see. Great. I think this part is super interesting, but let's move on to the future. Let's talk about 2020, 2024. Using your crystal ball, what do you see in 2024?
Yeah, I mean, we'd love to have a crystal ball to be honest.
But make your love.
It would make our jobs way easier. So first of all, I think that we are still there. This year is going to be still a year where VCs are going to be very, very careful. I think number of deals and volumes invested are going to be in line with 2023. Hopefully a little bit better. I say hopefully, because we have a bunch of portfolio companies that are going to fundraise this year, and we hope that there's a willingness for those companies. But I think we're not gonna see a huge recovery or coming back to 2020 or 2021 levels, and I think that if we see that anytime over the next 15 years, it's gonna be down the road, and just following the market growth. One of the things which is interesting is that normally what we are seeing in private markets is that private markets usually follow what's happening in public markets, but with a 6 to 10 months delay. And public markets have closed 2023 very good, at least in tech, with very, good performance. So I believe that this is gonna do two things. First, it's gonna, open a lot of M&A opportunities and liquidity opportunities for funds, way more than what we have seen in 2023, with where, M&A has been almost, dead. We've had three relevant IPOs in the tech markets that are Klaviyo, Instacart, and 𝗏. And I think that has opened, the idea that, okay, there's a place in 2024 for companies to start getting liquidity, and that's good. That will start, waterfalling back to the private market. So that's why I believe, I'm positive, but I don't think we're gonna see a huge increase on investments. I think it's gonna be some sort of the same, or maybe a little bit lower. And what we will see, and I believe we are already seeing, is that, and that's what this chart is talking about, is LP willingness to invest in venture capital funds. So basically, and coming back to what we saw during 2021 and 2022 is that, LPs had, or they had what's called the denominator effect, which is basically, as they have huge exposure in public markets, and public markets went almost crashed, like their overall exposure to VC, which is, a high liquid investment, like it became super important for them. So they were overexposed to venture capital, which basically made them to decide, okay, the next year we're gonna reduce our investment in VC just by the fact that we are overexposed to this. So I think this is something that we're gonna still see in 2024.
And this is what we were talking before about funds that may shut down or stuff. Like it's necessary. It's a natural conclusion.
Yeah. So that's basically, introduces what we have seen already in the market. So there's been a lot of, movement in the VC world, like from some funds that have decided to close shop or, reduce heavily their teams and their strategies and their fund sizes, to, some consolidation in the market. So very interesting deals, like what General Catalyst did with La Famiglia, which basically was acquiring the whole firm. Founders Fund was, super, it was really heavy this case where, they wanted to raise 1.8 billion and ended up, raising way less than half of that. So I think we're gonna start seeing a lot of this in the market. Or OpenView, like reducing their headcount by, I think, more than half of it. Stride, which is a UK-based fund that, announced that they were not gonna raise their second fund. And I think we're gonna start seeing, some sort of things like this in the market over this year and probably 2025 and then 6.
Okay, what does that mean for the startup founder? Like to have less funds or this consolidation of funds? It's like less noise or less opportunities, more professionalization on the VC side?
Yeah, I think money is not free anymore for founders. Like I think fundraising is going to be way harder for founders. The bar is going to be way higher. LPs are also going to, require greater, bigger or, larger returns for them, given, the fact that, interest rates are how they are right now. So I think for founders, this basically means that the VC asset class as a whole has raised the bar. So you need to really be able to deliver good returns and good, have good stories of both growth and path to profitability in order to raise money from VC funds.
I see. And I guess, this slide is more or less, well, a bit more optimistic than what you were saying, I guess. But
no, it's basically, basically the same. It means like there's still dry powder, but funds are struggling to and are going to struggle a lot to raise. And there's an important thing, which is, during these 2-3 years in 2020, 2021, 2022, there was a lot of new funds. There was a lot of, funds that really raised money. And these funds are going to need to go to the market in 2024 and 2025. And if they are not able to show that, the investments they did in 2021 were good investments, good valuations, fair valuations, companies are really being marked up and, creating value, those funds are not going to be able to fundraise their next, generation of funds.
In terms of particular industries that in 2024 may kill it, also like continuous or incoming?
We've talked a lot about this at the beginning about AI, but I think 2024 is going to be a year where AI is going to get all the headlines. I think that these, infrastructure part, or the companies that are providing, the core technology, which are the LLMs in this case, is already, very well funded. So what we will see, I believe, here is like how people is leveraging this to build companies and to build high growth companies. So is it going, is it going to be companies that are just a wrap up on top of, OpenAI and that are very good at selling whatever they are or whatever product they are selling? Or is it going to be, AI doing that by themselves? So I think there's a bunch of questions that we're going to see answered during these years. Like, for example, what are the models that are really going to be successful? Is it going to be just a large model like OpenAI, or we're going to see a bunch of different vertical models, from these big companies? And also, one of the things we were discussing before, which is, okay, how sustainable in the long term, and what are the unit economics of building a company that's basically leveraging OpenAI? So that's basically using OpenAI to provide a service. And I don't know if, this business model has, enough margins and, it's enough defensibility to build a company based basically on that. What we are seeing already is that there's a bunch of companies that are trying to be, very vertical, using AI for specific pain points, etc. We'll see. I mean, it's going to be a very interesting year. I think that there's a lot of opportunities in this application era of AI, which is basically leveraging everything that's happening with LLMs. But it's, I mean, we always talk about, similarities between different waves in different, in different times. And we believe that AI can be a wave that can be as huge as mobile, or even as when internet or the internet protocols were born.
I see. So yeah, so in general, like use cases, like we can find a trillion, right, for this Gen AI new thing. So I guess the guys that put the infrastructure are gonna get very rich, and then let's see who finds the use case.
We'll see how they are able to defend their margins, because at some point they can be also harmed, like if you see margins of the semiconductor companies that were born in the end of the 90s, and where the value of the infrastructure that these guys were preparing, and the value went all to the big tech companies like Google or Meta. So we might see something like that, and I think this is one of the key questions that probably will be answered in the next 5 to 10 years.
I see. And I saw your next slide was on fintech, and to me it's crazy to think that it could still multiply by 4, I think, or almost 4. That is so. What are these changes that can like trigger that further growth on top of what we have seen already?
Yeah, I mean, to be completely honest, this slide, like, I think fintech as a whole is going to grow just by the fact that there's a bunch of places in the world that are still unbanked, and that basically provides you some sort of a good platform to grow, and most of those places are unbanked, but almost everyone there has a smartphone. So I think that's where fintech can play a huge role. But we'll see. I think this is a space that it's going to be as interesting as it's been over the last years. Then we have climate also, which basically I think this year is going to be the year where we should start to see some very good climate tech companies. I don't know if becoming unicorns or if there's going to be a lot of unicorns, but I believe that we will start seeing some companies really adding a lot of value in the climate space, and proving that there's money to be made while doing good things for the planet.
Any other trend, or that's
No, I
climate,
think
AI,
well
fintech?
we spoke before about Web3, and I think decentralization is gonna come back this year. I think as a topic. I think we're gonna see things there. But again, and there's a lot of people that says the mix between decentralization, blockchain, and AI, it's gonna enable some business models, and we'll see how that plays out.
Great. So what to do in 2024 from VC perspective or from startup perspective?
Yeah, I think the plan for anyone that has a tech company this year is to be able to live and survive, knowing the fact that you might not be able to fundraise anymore, because the paradigm is what it is, and it's super tough to fundraise. But I think that given the technologies that we've been speaking about before, there's a bunch of opportunities, and there's also it's going to be one of the first times in history where you can leverage a technology like AI to do things in a way more profitable, in a more profitable way than things were done before. So if companies are able to leverage these technologies and to become efficient and to keep growing, I mean that's going to be a good year for them. I think the ones that are not able to provide that, those are going to have to choose between either closing shop or trying to be in some sort of a survival mode.
I see. Yeah, also I think it's pretty crazy on that slide that you were showing that I would say, like, beyond Series A or Series B, I mean, the startup doesn't mean that it's going to go amazing, but it usually doesn't go like pure default. But
yeah,
it seems that
this is basically an effect of what we've been talking that happened in 2020 and 2021. So these crazy rounds with companies that are even not making money, like zero revenues, and raising tons of money, and that's I think there's a bunch of these 112 companies that shut down in 2023, that were businesses that raised tons of money without really showing to the market that they had something to offer. And I think that's not going to happen in 2024. I think this number for 2024 is going to probably be on the line or even bigger, because there's still a lot of companies that raised money back then and haven't been able to deliver. So yeah. So
then, as a conclusion, like in this kind of I mean, not crisis, but like back to reality mode, let's invest more, let's invest less. Like here we have this quote from Warren Buffett, definitely not the father of venture capital, but definitely a good investor. What's your take on that? You agree?
I agree completely. I think it's a very, very, I think it's great times, both to build a company, to invest in tech companies. I think that, this makes founders and entrepreneurs being way more frugal, doing way more with way less. And I think that's the way to really create a company that's efficient in the use of capital. So I think that, and mostly in Europe, I think that there's great companies, there's great entrepreneurs, there's a lot of hubs like the one that we have in Spain, with a lot of big platforms and big companies that are producing new entrepreneurs. Like there's a lot of success stories, and if I think that the ball is is moving and in Europe, and I think that we have an opportunity to really build what we have seen being done in the other side of the ocean. I think we can do it in Europe. I think we can build huge companies out of Europe. We have the talent, we have the capital, and we know what's happening out there, and it's just a matter of doing things efficiently and without become crazy about burning money and hiring. Just do that if you are really producing revenues and creating value for your customers.
Great. So summary of takeaways. And we're already 6:30, so yeah, just quickly, and I'll tell a minute of academy, and then I will.
Super. Yeah, so I think I would like key messages. I think AI is going to still be super important this year, and it's gonna get a big chunk of the VC money. And there's a bunch of other things like climate or Web3 or health tech, which we haven't spoken about, but it's going to be huge also in 2024 that are going to still grab money. I think the key message within the sectors is that, things like delivery services, things like, classifieds, I think this is, this is over for tech investors. I think we're gonna go, after things that are way more deep tech and that can really produce transformational things and things that, at least in Europe, can make us, compete with the rest of the world. I think that we will see, I don't know if growth of VC investment, but the pace is gonna be somehow similar to what we've seen in 2023. But I do think that 2024 is going to be a huge vintage, and it's going to be very good. I think there's going to be good funds out of this year, and also very good entrepreneurs and entrepreneurs that can raise in this environment. I think they're going to end up being successful. And one of the things to be seen is what regulators do in this context. Both of economical slowdown and specifically when you're talking about AI and the use of data of these models, and the potential threats that these LLMs have to us as a society.
Great. So well, thank you very much, Jordi, for your insights. Super cool. Let's see what happens in the end. I wanted to show a bit of all the content that we have that I mentioned at the beginning. First, I encourage you guys to check the Startup CFO channel in YouTube. We have, the playlist here, you can see like many interviews or webinars of this type in Spanish and in English, many videos that we have made with content. Also, by the way, feel free to reach out to us, either Jaime at @tscfo.com or Jordi at KiboVentures.com. Happy to get in touch. And then also take a look at the Startup Academy site. And then here you guys can see more detail on our courses, both Startup Finance that starts actually this week, but you guys have 3 weeks more to sign up, or the Venture Capital course that the next edition is in September. We have had already over 400 alumni from everywhere, and many good collaborators, especially of course Kibo Ventures. We have like student feedback, we have videos, we have like profile, we have media, and of course detail on the courses as well, like all the syllabus, the methodology that is purely online, and all that stuff. Well, here it's charging, yeah, and you can see like all the topics here. Well, thank you very much, guys. Again, you can find it online tomorrow probably on our YouTube channel, and feel free to reach out to us. Thank you very much for your time. Thank you, Jordi, as well for your time.
Thank you all. Thank you, Jaime. Cheers.
Bye.